Stop what you're doing. The silver story everyone thinks they understand just flipped completely, and the next move is about to make a lot of people look foolish in public. Most are staring at a screen, watching a number, oblivious to the real battle happening behind the curtain, where paper promises clash with actual metal. And if you've been waiting for that perfect moment to buy or sell, I've got bad news. It doesn't exist anymore. It's Monday, January 26th. The time in New York is 3:32 p.m. Where are you watching this? Take a mental note, because this story spans continents. Here as the headline, silver isn't just moving, it has splitting into two separate markets. That split? That's where the shock hits. I'll break down what's driving this, why the stock market is bouncing like it's on caffeine, what central banks are signaling with interest rates, and the geopolitical forces that most investors ignore until they hit like a punch in the face. In the middle of it, I'll challenge a narrative that sounds smart, but quietly sets you up to fail. Stick around. The last 5 minutes are where it all clicks. Let's start with supply. You can't just turn on new silver like a faucet. A huge portion comes as a byproduct of copper, lead, or zinc mining. Prices can spike, but miners can't suddenly dig up more silver. It's incidental. That makes supply stubborn. Global silver production hovers around 1 billion ounces per year. When demand presses against that ceiling, prices don't rise politely. They rise sharply. Here's the twist. The buyers who matter most often can't back off. Manufacturers don't stop building because silver is expensive. They pay up where needed, substitute where possible. This isn't a retail craze. It's a tug-of-war between two forces. That's the setup for a move that blindsides anyone thinking in straight lines. Lazy answers claim silver is running because of inflation, uncertainty, or safe haven demand. Sure, that's part of it. But silver is dual-natured. Part insurance policy, part industrial powerhouse. And the industrial side is louder than most realize. Think power grids, data centers, EV charging, solar, chips, military tech, medical devices. Silver is embedded in almost everything. Not because it's rare, but because it's tricky to replace at scale. Even moderate demand plus tight supply creates tension. Reports point to ongoing deficits. One estimate put last year's shortfall at over 100 million ounces, consuming more than producing. Inventories shrink, and they aren't infinite. Yet silver can still drop suddenly like a trap snapping shut. Why? Leverage. Paper markets can drive massive selling without a single ounce moving. Stops, margin calls, forced liquidations. Physical premiums often stay high even as paper gets dumped. Picture this. Paper is a speedboat. Physical is a cargo ship. Speedboats whip around and make waves. Cargo ships move actual weight. When the cargo ship shifts, speedboats eventually feel the wake. That's why spreads matter. They reveal the strain in the system. And if strain keeps building, the market exposes bluffers. And someone is bluffing. Now the story deepens. Paper markets trade contracts at high speed. Physical markets demand real delivery. They coexist peacefully until inventories thin. Then the gap between claims and metal widens. Physical buyers paying more than paper buyers? That's a pressure gauge. And pressure gauges never lie. I spoke with a market professional who lives inside portfolios and risk management every day. He started with gold. Gold moves when confidence erodes. Every geopolitical flare-up, trade threat, or political shock pushes money around. Silver? It rides a tailwind from fear. But the bigger driver is industrial demand and supply. Solar alone consumes far more silver than a decade ago. AI isn't just a cloud. It's racks of servers, power infrastructure, cooling systems. Coin shops only show half the picture. Metal is moving from Western vaults to Asia. Momentum, trade, policy, they're shifting the center of gravity. When physical flows one way and paper contracts another, distortions appear. Not conspiracy, plumbing. The stock market, emotional roller coaster, calm one day, chaotic the next. Headline risk dominates tariffs, conflicts, political shocks. One day calm, the next day panic. Interest rates and growth collide. Investors chase growth, but rising rates make long-duration assets fragile. Add headline risk, and markets swing violently. Here's reality. Markets punish both the early and the late. Predictions die. Positions survive. Slow down. Think in probabilities. Sticky inflation keeps central banks cautious. Growth cracks push easing. Easing plus deficits can soften currencies, repricing commodities and metals. Geopolitical shocks amplify it. This is macro, not just silver. Economy snapshot, jobs steady, inflation sticky near 3%, rates uncertain. Rate cuts aren't always a party. They can signal trouble. Cuts due to controlled inflation, soft landing. Cuts due to credit stress, hard landing. Hard assets can thrive while risk assets stumble. Government interest costs and rising debt constrain policy, often leading to currency dilution. A strong dollar is relative, not absolute. Survival strategy, pair growth exposure with value and dividend assets. Dividends pay while you wait, helping prevent emotional mistakes. Tech, crowded trade. AI build-out continues, but valuations remain fragile. Timing is everything. Growth trends alone don't protect you. Cash flowing assets provide stability. Interest rates, again, cuts can signal trouble, not opportunity. Always ask why, not just what. Timing is critical. Silver, tech, macro, rates, they're all connected. Ignore one piece and you misread the entire chessboard. Supply constraints, industrial demand, leverage, geopolitical pressure, economic fundamentals, so all layers must be understood. Recognize the layers and the chaos finally makes sense. Metals, energy, real assets, cash flow, they're all connected. And right now, that connection is more important than ever. Let's start with energy, because this is where the next shock might begin. Energy is leverage. Control energy supply and you influence inflation. Control inflation and you influence interest rates. Rates drive currencies, and currencies drive demand for metals. So when oil-rich regions become the focus of global power plays, don't shrug it off. It matters for your grocery bill, your portfolio, and your plan. Here's the first cliffhanger. The next big move in metals may not start in metals at all. It could start in energy. If inflation is high but growth isn't collapsing, central banks have cover to stay on hold. That doesn't mean rates stay elevated forever. It means they move slower than the crowd expects, and impatience builds. When they finally cut, risk assets might surge, but weaker currencies then ripple into commodities. Metals benefit because they're not just a hedge, they're purchasing power. When currencies lose strength, hard assets reprick. Gold has been sending a clear signal. Fresh all-time highs, headlines have touched $5,000 per ounce. That's not a minor move, that's a statement. And when gold makes statements, silver often gets dragged along, but differently. Silver has a temper. It lags, then explodes. It shocks, it scares, it surprises. In retail markets, silver is the most emotionally violent metal. The conversation inevitably turns political, and politics is no longer a sideshow. It's a market variable. The big question, is the US trying to maintain dominance while rivals push harder? Yes, but not for pride. It's about logistics and leverage. Control trade routes, energy flows, critical materials. You control negotiation power. That's why the Western Hemisphere is suddenly in focus. We can't know every confidential conversation, but incentives are visible. Energy, shipping choke points, minerals, they matter. Major moves around these points, chess, not chance. Here's the skeptical perspective. Aggressive moves can trigger exactly what they aim to prevent. Countries diversify, trade shifts, payment systems evolve. Power moves create counter moves. The world is messy, and messy worlds favor hard assets. So what does this mean for your decisions? Patience, diversification, a plan that survives news cycles. Trying to trade every headline is competing with algorithms and professionals. It's a losing fight. Build a portfolio that survives imperfect timing. Layers of growth, value, cash flow, hard assets, liquidity. For many, that includes metals. 2 questions to consider. Will paper prices continue to lead, or will physical markets force them to catch up? 2, if silver spikes, is it retail excitement or industrial institutional scrambling driving it? Sentiment matters more than most people realize. Calm markets mock metals. Chaotic markets treat metals as obvious. Emotions create bad timing. The market doesn't give permission, it gives consequences. The dollar is not a personality, it's balance sheets and trust. Even dominant currencies can lose purchasing power over time. Hard assets act as anchors, not perfect, but real. Historical perspective. There have been periods with high nominal rates and negative real rates due to inflation. Those periods are fertile for precious metals because the opportunity cost of holding them drops. If markets start pricing in negative real rates again, it could fuel repricing. Consider a major investor decades ago who accumulated massive silver. Held today, it would look like a monster win. Past trades aren't guarantees, but silver can stay undervalued long, then reprick violently. It's not a normal asset, it demands respect. Why does this moment feel different? Multiple forces stacking, geopolitical instability, feeding safe haven flows, sticky inflation making policy uncertain, industrial demand continuing, tight inventories, and paper versus physical markets temporarily diverging. Rare combinations create shocks. Does silver move straight up? No, silver moves like a staircase in an earthquake. If you only watch the headline price, you're late. Buy euphoric, panic on pullbacks, sell to someone calmer, that's the cycle. Practical framework, stacking, focus on consistency and premiums. Investing, focus on allocation and risk. Trading, respect volatility and position sizing. Base decisions on the bigger map, not headlines. Risk is being repriced globally. Metals don't wait, they move. Starting from scratch, build a base you can hold through a storm. Emergency cash, reduce high interest debt, core allocations that match your risk tolerance. Stack slowly. Invest in a mix you can hold. Staying calm doesn't mean doing nothing. It means rebalancing when appropriate, adding positions when valuations make sense, not panic selling, not greed buying. Paper versus physical? That's trust. Trust is the hidden currency. When it breaks, liquidity disappears and prices gap. Watch spreads and signals, not for fear, but to position yourself before the crowd realizes the rules changed. Final takeaway, build a plan that survives headlines. Silver may re-prick without asking permission. Be the calm person, not the panicked one. Nothing here is personal financial advice. This is education, context, and a way of thinking to help you make better decisions in your own situation. Always do your own homework or speak with a qualified professional before risking real capital.